Hello, everyone. I am Raj, and welcome back. If you've watched the news lately, you've probably seen headlines about shifting global alliances, new trade tariffs, or conflicts halfway across the globe. As humans, it is completely natural to process these events emotionally. But as investors, we have to process them strategically. Today, we are talking about geopolitics and, more importantly, what it means for your hard-earned money as we navigate through 2026 and beyond. At EPK Capital, we build wealth for generations. Over my 20 years in investment management, I've learned one undeniable truth. The world is incredibly interconnected. A policy change in Washington, a supply chain disruption in East Asia, or a shift in energy production in the Middle East, all of it eventually finds its way to your portfolio right here in India. In the next few minutes, I'm going to simplify how these global gears turn, how they directly affect the Indian stock market, and exactly what you can do to protect and grow your wealth. Let's dive in. First, let's strip away the financial jargon. What exactly is geopolitical risk? Think of the global economy as a giant spider web. If you pluck a thread on one side, the entire web vibrates. Geopolitics is simply the study of how countries interact with one another through trade, politics, geography, and unfortunately, sometimes conflict. When countries get along, trade flows smoothly. And if there is one thing financial markets love, it is predictability. But when tensions rise, that's when the web shakes. Let me give you a very real, everyday example that impacts all of us. Let's look at crude oil and global shipping. India is one of the fastest growing economies in the world, but we still import a vast majority of our oil. If tensions flare up in the Middle East or Eastern Europe, shipping routes might get blocked or production might slow down. What happens next? The price of a barrel of oil goes up globally. For India, this means it costs more to transport goods. That truck carrying vegetables to your local market now costs more to run. Businesses naturally pass that extra cost on to you and me. Suddenly, inflation goes up. To fight this inflation, our central bank, the RBI, might keep interest rates high. And when interest rates are high, borrowing becomes expensive for companies. That can slow down their corporate growth. And subsequently, their stock prices take a hit. That is geopolitics in action. An event 4,000 miles away just influenced the net asset value of your mutual fund. But here is where it gets incredibly interesting. Geopolitics isn't just about risks. It is also about massive, generational opportunities. Whenever there is a shift in global power or a disruption in trade, money doesn't just vanish. It moves. Take the ongoing technological and trade competition between the West and China. Global corporations realize that relying on a single country for all their manufacturing is a massive risk. This birthed the China Plus One strategy. Major global companies decided they needed a backup plan. They needed another massive, capable, and democratic country to set up factories. And who is stepping up to the plate? India. From electronics and smartphones to pharmaceuticals and specialty chemicals, Indian manufacturers are seeing a massive influx of global business. If you are an investor who understands this, you are actively looking for the Indian companies winning those global contracts. Similarly, look at the transition to green energy. As countries fight for energy independence, billions of dollars are flowing into solar, wind, and battery storage. Geopolitics is accelerating the green energy boom, creating an entirely new sector of investment opportunities right here at home. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRIs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Let's continue now. So, as a smart, forward-thinking investor, how do you handle this? How do you build a portfolio that can survive the shocks and capture the growth? Here are 4 simple, actionable steps you can review today. Number 1. Expand your horizons. The Indian growth story is phenomenal. But India shouldn't be your only engine of growth. By allocating to international funds, perhaps in the US markets or other emerging economies, you ensure that if one region faces a shock, your net worth doesn't take the hit. Number 2. Keep a shock absorber. In times of extreme global uncertainty, institutional investors flock to safe havens. Historically, gold has played this role perfectly. While we don't recommend putting all your money in gold, having a strategic 10 to 15% allocation acts as an anchor when markets get choppy. Number 3. Focus on quality, not headlines. When news breaks, markets react emotionally. We call this noise. But great companies, businesses with low debt, strong cash flows, and excellent management will survive and thrive through multiple geopolitical cycles. Don't sell just because of a scary headline. And number 4. Embrace volatility through staggered investing. When geopolitics makes markets drop, it is essentially a clearance sale for great assets. Continuing your SIPs ensures you are buying more units at lower prices, which supercharges your wealth when the dust settles. At the end of the day, managing money through geopolitical shifts isn't about predicting the future. Nobody has a crystal ball. It is entirely about preparation. Ask yourself, are your investments positioned for the realities of the world today? Or are they built for a world that no longer exists? At EPK Capital, we design resilient, multi-generational wealth strategies. We stress-test portfolios against these exact global scenarios so that our clients can sleep peacefully at night, knowing their family's financial future is secure. If this video made you think, or if you're curious about your own roadmap, we should have a conversation. Reach out to us at EPK Capital. Let's sit down and ensure your wealth is built to last. Thank you for watching. Don't forget to subscribe. Until next time, this is Raj. Invest wisely and stay prepared.